Kenya's Equity Bank reported full-year results showing a 17% rise in earnings per share to 3 shillings 26 and a dividend of 1.25 shillings per share, up 25% year-on-year. Equity Bank also exceeded expectations with a 36% increase in pre-tax profit. And joining us now live from Kenya is the CEO of Equity Bank, James Mwangi. James, thanks so much for joining us today. Well, as I say there, a 36% rise in pre-tax profit coming through, and that above even your own expectations. You say you've seen solid growth in your loan book and a jump in net interest earnings coming through in a very big way there. How sustainable a growth picture are we looking at here?
Thank you very much. We're of the opinion we'll be able to sustain and enhance this growth rate because it is being driven by strategic initiatives that are leading on the competitive advantage of the bank. The first one is diaspora remittances, which seems to constantly be growing, and we are currently the biggest player in that space. The mobile and agency banking model has brought enormous enhancement of our high volume, low margin business model by delivering convenience and ease of banking to the larger population. And that has really helped to grow the funding base of the bank. At the same time, our move to SME lending again has really cushioned, and we are seeing rapid growth. Well, the average growth of the loan book for the industry was 8. We were still able to achieve a 19% growth rate, and achieving it with SMEs, which are low-risk clients. So we expect that to be sustained in the medium term.
Well, you've certainly achieved and deserved status of innovative bank with that mobile banking services that you provide and that you've highlighted, taking things to a new platform. You've been catering to the unbanked segment of the market. How much scope for growth are you looking at in that regard, James? Or are we looking at saturation levels on that front being reached sooner rather than later?
We are now operating in a region with 126 million people, but the banked population is less than 30 million. So we would comfortably say we could be able to triple the number of banked customers within the region. More specifically, the region is now growing at an average of above 6%, and that again will allow a lot of people to graduate and to become more bankable. So we would expect to be able to sustain growth in numbers maybe for the next 10 years.
You're now more so than ever before talking about this regional growth, James. You've got operations, of course, in 5 of the East African countries. Talk us through the growth that you're achieving in the other territories relative to what you're achieving in Kenya, and how you see the rest of that East African region contributing to your earnings moving forward. Have you set targets in that regard?
We launched this strategy about 3 years ago, and we now have 15% of our total assets coming outside Kenya. And this 15% asset base is also matched by a 15% revenue contribution, confirming that the model as operates in Kenya has been replicated the same way within the region. We see huge opportunities of growth, particularly in Tanzania, Rwanda, Uganda, and South Sudan, basically because these countries are much more or less banked than Kenya. So that gives us a huge opportunity for growth. At the same time, those 4 countries seems to be growing faster than Kenya, again suggesting the need and desire for banking services are more required in those countries. So we expect, hopefully in the next 2 years, the region would be contributing nearly 30% of total income, while Kenya will be reduced to about 70%.
As you see those investments being made, James, you've got to be watching that cost line very aggressively as well. I mean, you've got your cost-income ratio for the group coming down from 50% to 49% currently. Are you happy with that level, or do you still have quite a bit of work to do when it comes to whittling away at costs?
There is quite a bit of work to do. I expect this year the cost-income ratio will drop significantly, maybe to 48 or 47, simply because last year was the initial investment cost in both Tanzania and Rwanda. So the cost structure was much higher than the revenue structure. So with those two countries now joining in to contribute significantly to revenue, we'll expect the cost structure this year to go. So the desired cost structure in the medium term is 45.